Welcome to the deep dive. Today, we're plunging into something really fascinating, a bit of a paradox, actually. You know, the swoosh, you've definitely heard, just do it. Nike, I mean, they're one of the most globally recognized, truly iconic brands out there, just woven into sports, into culture. Yet, if you've been watching the stock, NKE, well, it's been struggling significantly. It almost feels counterintuitive, doesn't it? So, what's the real story here? What's going on behind the scenes with this titan that seems to be at a crossroads? Our mission today is, well, a deep dive into Nike Inc. We're going to peel back the layers on those recent headlines, really dig into the underlying business, and ultimately help you understand whether the market's current pessimism, this negativity, actually presents a compelling investment opportunity. We're going to clarify some really opposing viewpoints on Nike and hopefully shed some serious light on what can be a, let's face it, complex situation in stock investing. Get ready for maybe a genuine aha moment because we think the market might be missing the bigger picture here.
That's exactly right. The headlines, yeah, they scream struggle, but we're going to look at why those very struggles, believe it or not, could be creating a pretty rare window. A window to acquire a world-class leader at, potentially, a significant discount. We'll be looking at Nike's financial health, its intense competitive landscape, and its current valuation. The goal is to really understand why the stock has underperformed so dramatically, and crucially, why we believe there's a different, maybe much more optimistic story playing out underneath all that noise.
Okay, let's unpack this then. The executive summary from our sources. It paints a picture of Nike navigating some, well, pretty significant short-term headwinds.
Mm.
For anyone watching their portfolio, these numbers can look frankly concerning. What exactly are these immediate pressures hitting them so hard right now?
Well, yeah, the numbers from fiscal year 2025, they show clear pressure points, and they certainly grabbed a lot of attention. We're looking at a 10% year-over-year revenue decline. That's pretty substantial, and it's broad-based, hitting all their geographies. But maybe even more concerning, at least from a profitability angle, is the substantial gross margin compression. In Q4 of fiscal 25, their gross margin plummeted. A sharp 440 basis points. That's a huge 4.4 percentage point drop down to just 40.3%. And that steep decline, well, it tells us they really had to resort to aggressive inventory clearance, heady discounting, basically, just to move product. And the bottom line naturally took a hit too, a significant 44% drop in net income for fiscal 2025. You see this weakness showing up across both their Nike direct channel that was down 13% and their traditional wholesale channel, which was down 7%. Even the Converse brand, which is its own segment, was particularly hard hit, down 19% in revenue. And then, of course, there's the intensifying competition, especially from those agile, high-growth players like Hoka and On. They're really making inroads.
So, wow, on the surface, those numbers are a bit of a gut punch, aren't they? For someone like you who probably sees Nike everywhere every day, is this just a bad quarter, a blip? Or are we looking at something maybe deeper for a company that seems so totally entrenched? What does this all really mean for Nike's, foundational strength?
Yeah, it's a great question. And what's fascinating here, truly fascinating, is that despite these near-term struggles, despite all the negative headlines, the core of Nike's long-term value proposition, what we call its wide economic moat, that seems to remain firmly intact. Think of an economic moat like a castle's defenses. It's a deep, sustainable competitive advantage that protects a company's profits and market share from rivals. For Nike, this really starts with their intangible assets, specifically brand power, the swoosh. It's just unparalleled in recognition. And the just do it ethos, that's gone way beyond marketing. It's practically a cultural mantra. This isn't just about a logo, it's an emotional connection. And that fosters immense brand loyalty. This loyalty, it's what allows Nike to consistently command premium pricing for its stuff. And they reinforce this constantly, year after year, with massive marketing budgets, huge endorsement deals. Think Michael Jordan, LeBron James, global icons. It makes it exceptionally difficult for any competitor to truly replicate that level of sort of mind share and emotional connection. Then you have their cost advantages, economies of scale. As the largest sportswear company in the world, Nike benefits enormously from its sheer size. Their production volume, huge. It gives them incredibly favorable terms with manufacturers, especially in low-cost countries. And this scale, it extends everywhere. Global logistics, efficient distribution, massive ad campaigns that just dwarf what smaller players can afford. They can pour money into cutting-edge R&D at a level that, frankly, smaller competitors just can't match. It creates this virtuous cycle, constantly reinforcing their leadership in both brand and innovation.
Okay, but here's where it gets really interesting, right? And where you hear a lot of conflicting ideas. If their moat is so strong and this incredible brand, these cost advantages, how are they possibly, feeling the heat so much from everyone? From Adidas, sure, but also Lululemon and these newer, really fast-growing brands like Hoka and On. It almost feels like a sharp confrontation of ideas. Like, the brand is invincible, but wait, they're losing ground. What's the competitive reality look like?
That's a critical point, and it really highlights how dynamic this industry is. Look, Nike is the undisputed global leader in sportswear, no question. Our sources show they hold about 16.4% market share, according to Euromonitor for 2024, and even more, like 24.2% in the broader apparel, footwear, and accessories category as of Q1 2025. That dominance, it's real. However, the intensity of rivalry, as Porter would say, is incredibly high. You've got the direct head-to-head global competition with Adidas. That's perennial. Then Lululemon presents a really formidable challenge, especially as they push beyond yoga into menswear, footwear, hitting that premium athleisure spot hard. And then, yeah, as you mentioned, you have the emerging threats. On Holding and Hoka, they are rapidly capturing market share, consumer excitement too, particularly in performance running. They're building strong communities, leveraging innovative designs, focusing on comfort. They are definitely a tangible threat to Nike's share in specific niches.
So, leader, yes, but definitely not resting on their laurels. Or they can't afford to anyway.
Exactly. So while Nike leads, they are far from unchallenged. The good news, I guess, is that while the industry is mature, it's still growing at a healthy clip, maybe 4-7% compound annual growth rate. That's driven by global health and wellness trends, the whole athleisure movement, so there's still plenty of pie to go around. But the competition for those slices, it's fierce.
Okay, then numbers. They always tell a story, don't they?
Hmm.
Sometimes a pretty complicated one. Beyond the recent revenue and net income drops we just talked about, what do Nike's financial statements, the ratios, tell us about its overall health? Is it really, like, bruised but not broken?
Absolutely. I think that's a fair assessment. If we break down the quantitative side, we see Nike showed really robust growth from fiscal 2020, peaking at over $51 billion in revenue in fiscal 2024. Impressive. But yes, the trailing 12 months for fiscal 2025 show that sharp 10% reversal we mentioned. It's clear they're facing some operational stress, no doubt. Now let's look at profitability ratios. Even with these recent pressures, Nike's trailing 12-month net profit margin is around 6.9%, and return on equity, ROE, is 23.3%. Those remain quite robust.
Robust compared to who?
Well, to put that in context, they significantly outperform some peers, like Under Armour, for instance, which actually posted negative results recently. It's also worth noting, while Adidas, their main rival, recently showed a stronger gross margin, probably less discounting pressure, Nike still converts more of its sales into net profit, which, speaks volumes about their underlying operational efficiency, how they manage costs all the way down the income statement.
Okay, so profits are holding up relatively well despite the margin squeeze. What about debt? Solvency?
Right. Solvency and liquidity. Nike maintains a pretty healthy balance sheet here. Their debt-to-equity ratio is 0.83. That's well in line with peers, showing a manageable level of financial leverage. They're not overly burdened by debt, and their current ratio, which measures short-term liquidity, is strong at 2.21. That indicates they have plenty of short-term assets, cash, inventory, receivables to cover their short-term liabilities. This gives them crucial financial flexibility. Flexibility to navigate this downturn, keep investing in innovation, and even return capital to shareholders through dividends or buybacks.
And efficiency. How are they managing inventory? You mentioned clearance issues.
Yeah, efficiency. The asset turnover is strong, shows they use assets well. The really critical efficiency metric right now, though, is inventory turnover. At 3.53, it's actually higher than key competitors like Adidas or Under Armour, suggesting they are moving products more quickly. However, and this is the crucial bit, this has come at the cost of margin, due to that heavy discounting, especially clear in Q4 FY25. So yeah, they're moving product, but they're doing it at a lower profit, which really highlights the specific problem management is trying to fix right now. So this raises an important point. While there's clear operational stress, the financial foundation, it remains solid. It suggests these issues are more about, say, temporary execution challenges and inventory management, rather than some fundamental, irreversible decline in the business itself.
Okay, so summing that up. Strong underlying business, solid financials, but facing these temporary operational challenges and, yeah, intense competition. The market has certainly reacted, though. The stock price shows that. For someone like you, looking for an opportunity, what does all this mean for the stock's current valuation? Is there a disconnect here? Is this where the opportunity lies?
This is precisely where we see what looks like a truly compelling and definitely contrarian valuation. The market has been arguably overly pessimistic. The stock has materially underperformed the broader market, no question. And its valuation multiples, they've compressed significantly, well below historical averages. The market is basically pricing in all the near-term pain and perhaps discounting too much of Nike's long-term power.
So how do you quantify that? Like, with a DCF model.
Exactly. Our discounted cash flow, or DCF model, which, remember, tries to estimate a company's intrinsic value based on its future cash flows, it shows something quite different from the current market price. Our base case DCF analysis yields an intrinsic value around $95 per share, and we've built this model on, frankly, quite conservative assumptions. Just 2% revenue growth for the first 2 years, then picking up to 4.5% for years 3 to 5, a long-term terminal growth rate of only 2.5%, and a 9.5% weighted average cost of capital. Even with those fairly modest inputs, it shows significant upside from where the stock is trading today.
And relative to competitors or its own history?
Yeah, good point. Relative valuation tells a similar story. Nike's forward price-to-earnings ratio, the PE, it's now around 22.3 times projected earnings. That's much closer to Adidas, which is at about 21.4 times. But crucially, it's significantly below Nike's own historical 5-year average, which has often been up in the 25 to 30 times range, sometimes even higher. So while they still trade at a premium on, say, price to sales or price to book compared to some other apparel companies, the earnings-based valuation, which is often what investors focus on most, has become much, much more reasonable.
Interesting. So the market's view seems quite divided.
Absolutely. If you connect this to the bigger picture, look at the huge dispersion in analyst price targets. They range from a low of like $40.40 all the way up to 126 cents. That just underscores how uncertain the broader market feels right now about Nike's immediate future. But our synthesis, our analysis of all this, points to the market being overly pessimistic, creating potentially a meaningful upside at the current price for you. This really could be your aha moment. Understanding that disconnect between the short-term sentiment, driven by those immediate headlines and quarterly numbers, and the long-term intrinsic value of this incredibly powerful, globally dominant business.
Okay, that's a strong bull case laid out. So what needs to happen for Nike to really regain its mojo, its momentum, for that $95 target or something like it to be realized? What are the key catalysts? What should we be watching for that could drive this recovery and, bring back that brand excitement?
Yeah, the bull case really hinges on several potential catalysts materializing. First and foremost, I'd say, is the successful product innovation cycle. Nike's sport offense strategy, focusing on key categories like running, basketball. If that delivers hit products, it could absolutely reignite consumer excitement and, importantly, restore their pricing power. Bring back that brand heat. Imagine a new Air Max line taking off, or a breakthrough running shoe.
Where you gotta have the hot products.
Yeah.
What else? Second, inventory and gross margin normalization. This is absolutely critical. Getting that excess inventory cleared means less need for heavy discounting. That should lead to a significant rebound in gross margin. This is probably the primary financial metric you should be watching closely, as it directly feeds into profitability. A third major catalyst would be a reacceleration in Greater China. That region has historically been just a crucial growth engine for Nike. A solid rebound there would be a powerful tailwind for overall revenue. And finally, just successful execution. If they execute well on this turnaround plan, it could shift investor sentiment back in their favor, leading to a valuation re-rating, expanding those PE multiples back towards historical levels as confidence returns.
Makes sense. But of course, every investment has risks. No recovery is ever guaranteed, right? What are the major headwinds, the things that could prolong Nike's underperformance? What's the potential bear case here that listeners should be concerned about? Absolutely, got to look at the other side. On the flip side, several headwinds could certainly prolong their challenges or even derail the recovery. Persistent competitive pressure is a big one. If those market share gains by On and Hoka prove to be durable, like really sticky, and not just a temporary fad, well, that could definitely cap Nike's growth potential, especially in key performance categories. Sustained macroeconomic weakness is another risk. A prolonged global consumer spending slowdown would make it very, very difficult for them to regain pricing power and drive sales growth. People just buy fewer expensive sneakers when times are tough.
You mentioned issues with their direct channel earlier.
Yes, that's a major red flag we're watching very closely. The failure to revitalize their Nike direct channel. That recent 26% decline in Nike brand digital sales in Q4 fiscal 25, that's quite concerning because this direct consumer strategy, selling straight to you online or in their own stores, it's absolutely fundamental to their future growth and profitability plans. If they can't reverse that trend, it really undermines a core pillar of their long-term strategy. And finally, you can't ignore the potential material impact from tariffs. Nike themselves have estimated that potential future tariffs could result in an incremental cost of roughly $1 billion. That would be a significant hit to profitability if it actually happens.
Okay, one last technical point. What about beta? How volatile is the stock?
Good question. It's interesting. Historically, Nike's 5-year beta is about 1.22, which means typically the stock has tended to be about 22% more volatile than the overall market. But its more recent 1-year beta is actually lower, around 0.74, meaning the stock is actually decorrelated from the market somewhat over the past year. Its movements recently are being driven more by these specific company challenges we've been discussing, rather than just following overall market trends. So right now, Nike's performance is really more about Nike itself, not just the broader economy.
Okay, so let's try to wrap this up. To recap the core message for you, the listener, Nike is, without doubt, a world-class leader. An unassailable brand, really. But it's currently facing temporary, yes, but significant challenges. And those challenges have, arguably, disproportionately punished its stock price. Our analysis, digging into the sources, suggests these challenges are manageable, and frankly, the market might be being overly pessimistic about the long-term outlook. This is that sharp confrontation of ideas we talked about, the market seeing short-term pain, while our analysis points towards longer-term potential.
Exactly. The fundamental strengths of Nike, that brand power, the scale, the innovation capabilities, they remain firmly intact. Management has acknowledged the issues, they seem to have a clear plan to address them, and that strong balance sheet gives them the financial flexibility they need to execute that plan. So we believe the current valuation offers a potentially rare opportunity, a chance to acquire a stake in a true leader at what looks like a discount to its intrinsic value.
Right, so given everything we've unpacked today about Nike's enduring brand strength versus its current temporary struggles, it leaves you with a provocative thought to mull over. What other well-known, maybe even iconic companies might be experiencing similar short-term headwinds right now? Companies where the market might be overly focused on the immediate problems, potentially creating a unique opportunity for those of you willing to look beyond the headlines and understand the long-term underlying value. It's all about finding that disconnect, isn't it? And hey, to ensure you receive the fastest and most frequent updates on deep dives just like this one, be sure to subscribe to the Deep Dive,